Welcome to Global Risk Community Chat. Today our guest is Victoria Conroy. I'm very happy to have you here today, Victoria. Welcome.
Thank you very much. It's really a pleasure to be here. Thank you for the opportunity.
Likewise. So before we get into our discussion for today, can you briefly introduce yourself?
Certainly, yeah. So I'm the senior editorial strategist at SkyParlour, which is a fintech PR agency. It's been in existence for about 14 years now. We've represented companies from all across the payment and fintech ecosystem, from fraud management companies to card networks, to some of the really innovative fintechs that are coming up and doing amazing things, and things like consumer experience, app design, and so on. So yeah, I've got a good grounding in terms of working with companies across the ecosystem. I come with 20 years of payments journalism background as well. I started off as a reporter on Cards International and then Electronic Payments International. Became editor of Payments, Cards and Mobile magazine as well. And I've also produced a number of research reports for companies like MasterCard, Visa, HSBC, and some other leading names in consumer and commercial payments as well. And at SkyParlour, I'm basically responsible for devising the thought leadership topics, blog content, other marketing content collateral, and keeping an eye on what's going on in the market as well. So that's me in a nutshell.
Excellent. Thank you so much for sharing. So, as far as I remember, today we will be talking about account push payment fraud. So, well, let's get into it. So, what exactly is account push payment fraud? And yeah.
Okay, so authorized push payment is basically any monetary transaction initiated by a payer, a customer, such as an online bank transfer from one account to another. And APP fraud is where someone is deceived into authorizing a payment like that, either to an account that they think belongs to a legitimate payee, but is actually controlled by a fraudster, or for something that they believed was legitimate, but was actually fraudulent. So APP fraud is taking place across a number of methods, and some of the most common include impersonation scams, where criminals pose as a legitimate business or company. It could be a bank, a delivery firm, retailer, tradesperson, and they pose as those entities to trick consumers into transferring the money. There's also purchase scams, where fraudsters offer goods and services that never materialize. And this type of fraud is typically carried out online as well, often through social media, marketplaces, or fake websites that are mimicking legitimate brands. Then there's also romance scams, which have got a lot of attention in the press as well, when imposters enter into an online relationship with their victim and then go on to request money from them, often using a lot of emotional manipulation and backstories to make the victim feel like it's a genuine relationship. There's also things like investment scams, when criminals convince victims to invest in various schemes, often related to crypto, for example, with promises of high or guaranteed returns. And also loan fee scams, where victims are charged an administration fee for a loan that they never get. And also lost pet scams as well. Scammers claiming to have found missing pets, often demanding a ransom for their return. So the way that these methods are carried out is fraudsters are using a mix of social media, online platforms, SMS and text messages, phone, and email communications to deceive people into sharing sensitive data and transferring funds. And most of the time, they don't even need to hack into someone's bank account or steal payment data to conduct an APP scam. They can just as easily use Facebook or TikTok, for example, to convince people to send money. And very sadly, some people have had vast amounts of sums stolen from them, often hundreds of thousands of pounds. And the problem is, you know, because it's so widespread online through so many different channels, it's really the scale of APP fraud that is worrying a lot of people, just how easily it's perpetrated through so many different ways. You even got fraudsters claiming to be from tax authorities, like, revenue and customs, pretending to be, um, collecting tax payments. And obviously, when you get a call like that off someone, if you if you don't have the right information to hand and you don't know how to tell if it's genuine or not, people can be scared into giving over money when you ordinarily wouldn't do so. So, it's not so much the sophistication of APP fraud that's a worry, it's the scale of it that's, really skyrocketed over the last few years. The latest report from the UK's payment systems regulator showed that there was almost £460 million lost last year. But some experts believe that the true figure could be closer to around 700 million, as around a third of scams are thought to be unreported. So breaking down how APP fraud occurs, 76% originates online, but online fraud only accounts for around 30% of APP related losses. APP scams where the victim is contacted by telephone represent 16 of cases, but account for 43% of losses. With the way that APP transactions take place, most of them happen within the UK's faster payment system. But these don't typically contain any dispute or refund mechanisms like chargebacks that you will get on card transactions, for example. So the way that victims are reimbursed right now is that banks and payment companies currently volunteer to reimburse customers. Some payment firms are not obliged to reimburse customers for this type of fraud, but some banks do voluntarily under the 2019 Contingent Reimbursement Model Code for authorised push payment scams. Looking at reimbursement levels specifically, in last year, 2023, 67% of losses of APP fraud were reimbursed, according to the payment systems regulator in the UK. But it really varies across banks and payment companies as to the level that they reimburse people. Some firms are refunding almost 100% of cases, and others less than 10%. The way that the current framework works right now is that financial liability is placed solely on the sending firm. But this ignores, obviously, the role that the receiving firms play in preventing scammers from accessing UK payment systems as well. So with APP fraud rising so much over the past few years, this is really what's poked the payment systems regulator into taking action, which has led us to the new rules that they've been pushing out.
Yeah, I was actually just about to follow up with the next question because, as you mentioned, it's a very wide scam, fraud type, and even though it's maybe not the most sophisticated one, and a lot of people are affected, but also, like banks affected a lot. Like there's a lot of involvement from multiple stakeholders in this. So, what are some new rules governing this APP fraud and are they already in force or when are they coming into force?
So in June last year, June 2023, the payment systems regulator first introduced the proposed reimbursement requirements for APP fraud, with an effective implementation date of 7th of October 2024. So as part of the initial proposals, they required that APP fraud victims would be reimbursed by the sending payment service provider in most cases, with the cost of reimbursement split 50-50 between the sending and receiving PSP. But also, the PSR has emphasised that they need to protect customers deemed most vulnerable. And additionally, customers must be reimbursed within 5 business days, subject to stop the clock provisions that they're calling it, in the case where a sending PSP needs to obtain more information. There are 2 exceptions where customers won't be reimbursed under these new rules, where the customer has acted fraudulently or where the customer has acted with gross negligence, that is outside of the consumer standard of caution, and I'll go into a bit more detail about that a little bit later. So these new rules on the face of them sounded really straightforward, but the fact is that APP fraud just isn't as simple as that. What's complicating things is that the PSR has proposed a definition of gross negligence whereby customer must pay attention to specific directed scam warnings from the sending PSP, and the warning by the PSP must make it clear that the intended recipient is likely a fraudster. Customers must almost promptly warn the PSP about the scam transaction, but no later than 13 months after the last relevant payment was also authorised. And they must also respond to reasonable requests for information from their PSP, so the case can be investigated. So to sum up those rules, the burden of proof to prove APP fraud falls on the PSP to show gross negligence. But gross negligence is not applicable to vulnerable customers. PSPs will not be required to reimburse any APP scam payments where the consumer standard of care exception applies, unless the victim was a vulnerable customer at the time of the reimbursable APP scam payment was made. So, in essence, where potential cases of APP fraud are being investigated, the sending PSP will conduct an investigation, but they will not issue a refund if the sending customer has been grossly negligent. So it could be a scenario like where a customer thinks something looks like a great investment, but to most other people, it will be an obvious scam. To the point where the bank is telling the customer not to send the payment, but the customer sends the payment regardless. So when these proposed regulations were first mooted last year, the industry responded with a lot of concern and a lot of unhappiness. Everyone recognises that the PSC has got a really difficult job to do in trying to protect consumers, but also promote a healthy, competitive, functioning financial system as well. Many within the industry said that these proposed regulations in their first iteration could mean that we end up with a financial system that's not competitive, where only the biggest banks and biggest payment players with the deepest pockets can afford to operate. And what's prompted them to say that was the vagueness around a lot of these proposed rules, particularly around what constitutes a vulnerable customer. In the UK, the Financial Conduct Authority defines a vulnerable customer as somebody due to the personal circumstances is especially susceptible to harm, particularly when a firm is not acting with appropriate levels of care. So the four categories, if you like, of vulnerability identified by the FCA include poor health, for instance, illness, cancer, disease, so on. A negative life event, including, unforeseen unemployment, relationship breakdown, financial abuse. Low resilience, which means someone who finds it difficult to recover from a negative experience or financial shocks. And someone with low capability, including weak financial knowledge, poor digital skills, illiteracy, learning impairment, for example. So although the PSR requires customers to pay attention to warnings from their PSPs, it's also created a new exception in the rules by saying that consumer proceeding with the transaction, despite the warnings, should not be automatically be deemed to be grossly negligent. And that the degree of negligence should also consider the nature of warnings by the PSP, the complexity of the scam, which can be really difficult to assess, history of the consumer, if they've showed a propensity to fall for similar types of scams in the past, for example, and whether the PSP had a chance to slow down or stop the transaction. So when you define gross negligence as part of the APP scam reimbursement, reality is that vulnerabilities of the victim must be considered to assess if gross negligence has occurred. And if most vulnerabilities aren't visible, how do you do this as a PSP? How do you determine who's vulnerable and who's being grossly negligent? If a scam victim has a combination of a life event and low resilience, for example, are they considered grossly negligent in a scam scenario? And we also need to remember that vulnerable customers are likely to be the ones most primed to be victims of financial scams like these. In lots of cases, you'll find fraudsters are deliberately trying to target these people or will access or buy breach data lists to identify vulnerable customers and then target them with these scams. Lloyds Bank shared some interesting data recently, which showed that its mule hunting team had identified a 44% increase in money mules over the last year. Basically, people who are vulnerable or otherwise who have been coerced into taking part in these scams. So, the number of vulnerable people is something that makes these scams so effective in the first place. So what the PSR is basically asking banks and payment companies to do is act as all-in-one criminal investigators, psychologists, financial advisors when determining whether APP fraud has taken place and who to reimburse. So that's one bone of contention. And then the biggest bone by far is around the maximum reimbursement threshold that was initially set by the PSR. It originally put forward a maximum figure of £415,000. And that was a figure that caused just absolute shockwaves across the industry. A lot of people asking, how did the PSR come up with this figure? Well, initially that figure matched the Financial Ombudsman maximum reimbursement limit at that time. That's a separate body that looks out for consumers. So the PSR set the figure to match that figure from the Financial Ombudsman. And the PSR's motivation for setting the figure at that level was that with such a high cap, which would also capture nearly 99.99% of APP fraud victims, that it would incentivize banks and payment firms to implement measures to reduce APP fraud losses. If that £415,000 figure had been settled on as the maximum limit, obviously it's going to be easier for a big bank with lots of financial resources to just decide that its blanket APP fraud policy will be to just refund everybody because they can afford to do that. And the other party in the transaction, the other PSP, wouldn't be able to do anything about that, even in cases where it's clear that the customer shouldn't be reimbursed. So when that figure was initially announced, it was immediately clear that smaller PSPs just wouldn't be able to take on that cost themselves and would be forced to push that cost onto their clients in some way. And then clients would then end up passing on those costs to their end customers, which essentially means people like you and me end up paying more for financial services. There's also the risk that some PSPs may have to offboard customers, forcing those customers to find a different provider. Or it could lead to a lot of PSPs just closing down, refusing to offer account-to-account transactions, for example, or leaving the UK altogether because they just can't afford to do business here anymore. So obviously there's been a lot of back and fro discussions since the PSR announced these rules initially and announced that £415,000 cap. The industry has lobbied really hard to get the PSR to reconsider on a number of these rules and elements. A series of consultations have carried on since last year to take the pulse of the industry and feed back to the PSR. We got the news a couple of weeks ago on the 4th of September that the PSR would launch a consultation lowering the £415,000 threshold down to £85,000. And the consultation, by the way, on that new £85,000 cap closes today. So it'll be really interesting to see what is being fed back into the PSR and the results of that. But it's highly likely that £85,000 will be the new maximum reimbursement limit. And then after that, the PSR will consider and confirm its final approach before the end of September, before the 7th of October implementation deadline. So that looks to be what the new cap will be set at and what has swayed the PSR to revise that cap. along with the intensive industry lobbying that's taken place, is the results of reviews that it's carried out itself. It found that last year, out of more than 250,000 cases it looked at, there were just 18 instances of people who were scammed out of more than £415,000, with over 400 instances of people being conned out of more than £85,000. So this proposed new cap will still see over 99% of claims by volume covered, and it's also in line with the revised Financial Services Compensation Scheme maximum reimbursement limit, which has also been revised down to £85,000. So that's good news for the industry, but it's still continuing to push for the threshold to be reduced even further. The figure that they've agreed on is £30,000. That would still cover more than 95% of APP fraud taking place through the faster payment system. And it's a figure that's still more than the average scam value of £12,000 for businesses and less than £2,000 for individuals. So to put it into perspective, the UK's long-standing liability for suppliers of consumer credit has a claim limit of £30,000 under the Consumer Credit Act of 1974. So that's why the industry is pushing for the maximum reimbursement limit to be reduced further.
Thank you so much. And as you mentioned, there are a lot of it seems like there are a lot of challenges regarding regulating APP fraud. So in your opinion, maybe what might be good ways to maybe overcome them, and what would be kind of like a message you would like to convey to the, stakeholders or policymakers regarding this topic?
I think there are a few ways that we could tackle this. There's a perception around the fintech and payments industries that the regulator is seeing banks and PSPs and others as just passively waiting around and only taking action on fraud when prompted to do so, and that's just not the case. Fraud hits everyone. It's devastating for the individual and the business involved, but it affects everyone: banks, payment providers, the payment schemes, and merchants who are faced with higher fees from the processors and acquirers. And those costs are inevitably passed on to the consumer. So every survey of senior payments and fintech leaders that you look at points to fraud as the #1 issue keeping them awake at night. And you can see this playing out with APP fraud specifically, where you're now starting to see a number of banks opting only to receive payments but not send instant payments. And that's creating an imbalance that, again, is going to negatively affect the end customer. There is a need to protect people from this type of fraud, but there will also be some friction in the customer's payment journey to make sure that they're protected. And striking that balance between security and the seamless payment experience is always really tricky to collaborate. But there are some possible resolutions. We're seeing how AI is increasingly being used to fight financial crime. We're seeing more focus shifting towards improving transaction monitoring, leveraging AI for pattern detection, for example, in response to emerging threats. But the industry has to not only deploy AI, but ensure that it's integrated properly. And that can be a challenge given that AI is not in itself is not properly regulated yet. So right now, that's why you're seeing so many companies across the ecosystem investing billions of pounds of dollars into new anti-fraud measures. So there is investment into strong transaction monitoring systems, machine learning based tools that can track various data points like device ID, account history, and transaction behavior. Obviously, as machine learning gets fed more information, it'll get faster and better at stopping fraud like this in real time. We've seen Visa and MasterCard in the last few weeks announce, multi-billion-dollar acquisitions of fraud detection firms and cybersecurity firms as well. But I think if you ask anyone in the payment industry, the #1 issue that would help fight APP fraud is getting the tech giants and the social media platforms involved as well. We still don't really have any legislation that involves them to the point where the APP fraud that mostly originates on the platforms can begin to be tackled. Obviously, stopping fraud at the source is the most powerful way to ensure people don't fall victim to an APP scam. I think the key takeaway I would give you is that financial sector has taken the lead on fighting fraud, but it's now time for public and private sector leaders, including big tech and social media giants, to join forces and tackle fraud head on before it does serious damage to people and businesses. I'd love to see more collaboration on data sharing between institutions, between banks and telcos, internet service providers. Sharing knowledge is always the quickest way to solve a problem, and proactive, preemptive action is always better than reactive knee-jerk responses. You could possibly create an independent APP fraud adjudicator who could take the burden of investigation off PSPs and banks. It could work as an independent entity that's funded by the industry. But obviously that's going to cause arguments in itself. So that's one possible alternative, to have a central body that looks at sending and receiving institutions and says, okay, we'll take it from here, we'll investigate and decide who needs to be reimbursed. You could also look at bringing out an industry-wide call confirmation feature, similar to what Monzo, the UK neobank, launched recently with its status call feature, which allows users to check legitimacy of phone calls or contact messages that they get. It works in the way that if a Monzo user gets a call purporting to be from Monzo, the app allows users to verify whether it's a legitimate call or a fraudster spoofing Monzo's number. I think if that was rolled out on an industry-wide basis, that would make a huge inroad into tackling APP fraud. And, it could have a similar effect to the confirmation of payee feature, which is being rolled out not just across the UK, but EU as well, allowing customers to verify bank account details before they send payments. But really, it's data sharing that is the key to solving this problem. If we can find a way to share information to stop scams like this happening at the source, it will have such a positive effect. I don't really know how that will work in practice because of regulations like GDPR, for example, and at present, there's no clear mechanism for data sharing and collaboration. But there's certainly enough impetus to set a precedent here, because fraudsters, as we know, are always going to keep evolving and keep moving to the next target. And they'll invariably use technology to perpetrate even more ingenious scams, for want of a better word. So I think those would be, the initial recommendations, I guess, that I would put forward as a way to tackle this problem. But I'm sure brighter minds than me will be able to put forward some more resolutions as well. I think that's pretty much everything I wanted to say on this topic in terms of APP fraud.
Thank you so much. And with that, unfortunately, we are running out of our time. So I want to thank you so much once again, Victoria, for sharing your thoughts on the topic, as well as, your insights. So yeah, thank you so much.
Thank you very much. Been a pleasure.
Likewise. Thank you.